that this bull run has been in a few key equities, but not really broadly across the S&P. It's been in gold, it's been in Bitcoin. But a lot of investors are wondering, is this going to stay concentrated as we go forward, or is this going to broaden out into the rest of the market? What are your thoughts on that? How do you see that playing out? Do you agree that the investment and the economic activity in this bull run is going to stay very concentrated as we go forward?
Yeah, I don't think it's necessarily going to stay concentrated. And I think there is, although it's just beginning, there is a changing of the guard of SaaS going from the top of the hill to not necessarily the bottom, but somewhere mediocre. And when I say SaaS, I mean software as a service. And this has to do with the fundamental devaluation in the importance of coding, right? And this is AI. And that's why I did watch your interview with Jordy. I would say that like 1 or 2 years ago, so I had actually never listened to people on YouTube until I left financial services. I worked 25 years in financial services. I was the CEO of 3 different SEC FINRA regulated broker dealers. I worked primarily in private markets. I was instrumental in kind of really breaking through how do we take private shares in these large public companies and disseminate them to the public at large. So I worked for 3 different companies, SecFi, EquityB, Vested. All of them, what we did was we pioneered innovative ways, not to get into the details of it, but it was through these antiquated prepaid forward contracts that went back to the railroad era to essentially be able to take these private shares and kind of disseminate them out. And I worked with FINRA and the SEC to pioneer. This is kind of how I, made what I made so that now I can trade and do what I want to do. But basically, pioneering this. So I understand that market, and I understand what Robinhood is doing, which is one of my favorite stocks and biggest holdings, and what Vlad's doing. And I understand what tokenization is doing, which if we want to get into, which is a huge thing that's going to disrupt the markets, the tokenization of equities, and other assets. But there's just so many amazing things happening. And so when I look back and I think, what type of an era is this like? Like, I really do think of industrial revolution. I think of railroads. There's a great story. There was some small little like seaside village in England that had like 20,000 people living in it. And at the peak of the railroad boom, like 3 companies were building railroad lines from London to this village. Like there was no way that there needed to be 3 railroad lines from London to this village of 20,000 people on the coast. And yet they were building it because railroads were so transformative. And I think AI and railroads are a great corollary. You think about what the world was like pre-railroad. You want to go from New York to San Francisco. Best thing you could do is get on a boat and go all the way under Argentina, like a 15,000 mile multi-month sea journey that then gets cut to like 1 or 2 weeks on a railroad, right? Across land. Because otherwise you were taking oxen, you were taking horses, you had these insurmountable mountains, you had Indian attacks, like the entire world changed with the railroad. And people got so into it, and literally we had these barons, right? It's very similar. It is eerily similar. Rockefeller, Carnegie, Vanderbilt, like these types of individuals, Ellison, Musk, Zuck, like, so we're going through this big shift. And it's like you go back on these 80-year time frames, there's a tie into financial history, and you say, okay, what is this decade kind of like? And I think if you really look, and this is why I love the 1950s as a corollary, and I think we had 2 big events in the 40s, 50s, right, that affected the economy and the world a lot. We had World War II, which I would equate to COVID. And a lot of people forget about this, but we had the Korean War, which I actually kind of equate to the GFC. And those happen in reverse order. World War II was before the Korean War. So for people that don't know about the Korean War, it was 1950 to 1952. There was a very big recession in the United States in 1953. I talked about the 1950s being a better decade for equities than even the 90s, an over 19% average return. So when people say we can't have 20% returns for 10 years in a row, bullshit. We had it in the 50s. Don't tell me like, oh, this can't happen. Like we people are going to say, well, Mel, what are you saying? We're going to have 10 years of 20% returns. So we're going to have a decade straight. We did it before. Maybe not in any recent investor's lifetime. Maybe Jeffrey Gundlach doesn't remember it, but it happened. It happened.
So you think that this rally that we're seeing from AI will eventually broaden out into the rest of the market? Is that what I'm hearing you say?
Yes, and not even so much so, but I lean towards some of Visser's leanings that this is maybe destructive for some of the monopoly type power that some of these Mag 7s have. And so I think that ironically, at the same point that people came to accept index funds are the best, that's when index funds are going to hurt people. When people are investing in, oh, well, you know what? Who can beat the market? Bullshit. I beat the market every fucking year. Look, the market is not hard to beat. Warren Buffett said it. Warren Buffett has said himself, it's easy to beat the market if you don't have to move around $500 billion in capital. Like people that want to tell you, you know what, it's impossible and Bogler and you want to invest in the SPX and SPX is up like 12%. I mean, I'm sorry. People can look at my chart. I'm up like over 100% this year on $1 million plus portfolio. This is ridiculous. Like you want to be up 12% in this type of a market? You're nuts. You're absolutely nuts.
Well, I think it's helpful again to get the history lesson on this, and there's a lot of opportunity out there. I want to kind of pivot this conversation in a little bit of a different direction. You brought up the debasement trade and how a lot of people are starting to pick up on this now. At the center of all of this, and like what's going on with the dollar and the bond market, is the Federal Reserve. And something you've been pointing out that I think is something a lot of people have been missing is that traditionally the Federal Reserve is said to have a dual mandate of price stability, so like controlling inflation and low unemployment. But you've been very vocal about pointing out that the original act of Congress that created the Federal Reserve in 1913 actually had 3 mandates listed. And a lot of people are saying that the Trump administration might want to start bringing this back. Could you tell us what is this third mandate and what would the impact on the market be if the Federal Reserve starts to have a third mandate instead of those 2 that it's had for so long?
Yeah. So, and this is one of the things, actually, I think Jim Bianco made a tweet on this over the weekend. There was some comments made, Nick Timmeros or some other people, basically like, I think it was Wall. I don't know who it was, but they were trying to point back to the purview of Fed monetary policy in like the 20s and 30s. And the point Bianco was making, and a lot of times I disagree with him, actually. I think he's a nice, very smart guy, and a lot of times he makes good points. Sometimes I think he makes bad points. He notably thought the Fed was making a policy mistake and there's no problem in the labor market. I think there is a problem in the labor market. He said basically the only reason the labor market wasn't creating more jobs is because immigration stopped. But I'm digressing there. The point is that the Federal Reserve has a very specific mandate that was revamped, refined during the 1970s under the Carter administration. The official name is like the Balanced Employment Inflation Act or something. It's colloquially named Humphrey Hawkins. But when people look at it, it gives 3 specific mandates for the Federal Open Market Committee. And again, I'm being very specific here. I'm not saying for the Fed. I'm saying for the Federal Open Market Committee, because the whole way the Federal Reserve used to set interest rates is very different over the decades. You used to have one interest rate set by the Reserve Bank of Chicago, and that could be different than New York, could be different than Richmond, could be different than Atlanta, could be different than St. Louis, so all of these things are changed. So to go back and say, well, this is what we did in the 20s or 30s is absolutely insane. It's insane that we don't have the Federal Reserve of the 20s or 30s. We have different laws that were put in place in the 1970s. So you can't say, well, we did this in the 30s, so therefore we should be able to do this in the 2020s. No, you have to say, what can we do under the statute? And under the statute, the FOMC has 3 distinct mandates, and they are manage unemployment, price stability, and make sure that long-term interest rates are moderate. And it's very clear in the mandate. It's not like not listed. It doesn't say this is like, something to the side that you shouldn't really consider. And I started talking about it like a year ago, and nobody else was talking about it. A couple of people might have on X, but nobody in mainstream media. And then Moran brought it up, and he said, Mirren, I believe is how actually I pronounce it. Mirren brought it up and said, look, moderate long-term interest rates are just as much as our mandate as is unemployment, as is price stability. So it's there in the law. And Powell, I thought, got dangerously close to a removable offense in the last press conference when he basically said, well, we don't really consider it, because if we take care of price stability and unemployment, we'll take care of it, moderate, long-term. Well, that's not for him to decide. Congress said these are the 3 mandates. You could just as easily say, well, if we take care of unemployment and moderate interest rates, inflation will take care of itself. That's a judgment call type of a decision that is not left up to the discretion of the chair of the Fed. The Federal Reserve is mandated to maintain moderate long-term interest rates. Anybody that says, well, the Fed only controls the short end of the curve does not understand history. And again, I'm going back pre-Humphrey Hawkins, and this is why I love the 1950s as an example, is we had explicit yield curve control, right? So we had a period where the government said, and it was not until the 50s that it was really lifted. It was the 1952, it's called the Fed Treasury Accord, where essentially the Treasury said, okay, Fed, we're going to give you some independence again. But one needs to remember that Fed independence is a gift from the executive and legislative branches. It's not something guaranteed constitutionally. And so at any point in time, the executive and the legislative branches can change the mandate of the Fed. They can do anything they want to the Fed. The Fed is not like, it's not like Article 8 of the Constitution establishment of the Federal Reserve. In fact, the central bank is something that from Jefferson to Andrew Jackson over history, Americans have radically opposed, because essentially what happened in the beginning of our government was we needed funding. And the way the United States used to fund itself was absolutely ridiculous. We used to like create bonds and then try to sell them in the open market ourselves. And we often sold them at 40, 50% haircuts. Like the US would issue $1 million in bonds and we'd sell it for 600,000 in the market. And we said, this is ridiculous. And what happened is a bunch of because in the beginning of our country, all the money was in Europe, a bunch of very wealthy European bankers said, let us create a bank. And make no mistake about it, the first central banks in the United States were more or less owned by Europeans. They said, we will manage your debt and we'll lower your spread between issuance and actually achieved incoming cash. And we needed it. And why did we need it? Because the world was on a gold standard. I mean, because you couldn't just print the money. We can now print. There's actually no need for the Federal Reserve. The Federal Reserve is anachronistic. The Federal Reserve actually perhaps hurts the country more than it helps. I think that getting rid of the Federal Reserve, the End the Fed movement, is considered kind of very right-wing nutso. I think in the coming years, it might become more mainstream, and people might say, why do we have a Federal Reserve? What are they doing? Because at the end of the day, and this is what people need to realize when they look at that symbol that Powell talks in front of, it doesn't say Federal Reserve. It says Federal Reserve System. System is the key, because what it is was, when it was set up, Creature from Jekyll Island, all this stuff, F.W. Griffin, everybody knows the history that really follows this stuff. This was created by bankers. And who owns the regional banks? The regional banks, literally the shareholders are JP Morgan, Citigroup, Morgan Stanley. It's like it is technically owned. Even the Supreme Court, when they said, we can't necessarily equate a Federal Reserve to an independent agency, because the Federal Reserve is a quasi-private entity. That was a polite way of saying that it's owned by the banks. So that's the reality of the world we live in. The Federal Reserve is owned by the banks. It's not some independent government agency.
Want insights on what's really moving markets and how we're trading each event? Subscribe to our channel, then join the Milk Road Macro and Macro Pro newsletters. This show is for educational purposes only. Nothing we say is financial advice. Investing is risky. Never invest more than you can afford to lose.